prices are going up. So dollars today buy a lot less than they did a year ago. So the dollar is losing purchasing power. It's just that when we typically think of the dollar, we think of it relative to another fiat currency, whether it's the euro or the yen or the pound. And if we see that the dollar has gone up relative to those currencies, we conclude the dollar is going up. But, if I'm in a car going backwards at 5 miles an hour and the cars next to me are going backwards at 10 miles an hour, sure, relative to those cars, it appears that I'm going forwards, but I'm actually going backwards. And so gold is what's telling you all the currencies are falling in terms of gold. The dollar is just falling less than other currencies for now. I think that is going to change. I think at some point the dollar is going to start to fall more. And when that happens, you're going to start to see a much bigger dollar rise in the price of gold. But I think one of the reasons that falling bonds are somehow supporting the dollar for now is that as bonds fall, yields rise.
Exactly.
And those higher yields are attracting dollar buying. People think, oh, higher yields are good for the dollar. Bond yields are rising, so let's buy the dollar. But I think bond yields are rising because of inflation. And inflation is bad for the dollar because it means the dollar's value is going down. And it means bonds are losing value because bonds are promises to be paid dollars at some future date. And the further into the future you're going to get paid, the more bonds should suffer due to inflation. So a 30-year treasury should lose a lot more value because of higher inflation than a 1-year, because you have 29 more years of inflation to erode away the value of your principal.
So at what point do interest rates get high enough to where people start looking at gold and saying, well, let me turn that gold back into dollars and let me just capitalize on that short-term interest rate? Or do you just think that that's not the case?
No, because I don't think rates can ever get high enough to do that, because you have to have real interest rates that would be high, not a nominal rate. And I don't think the Fed is going to get rates to a point where they're going to be high enough to offset what you lose to inflation, because such a rate would cause financial crisis. It would render all banks insolvent. I mean, they're already insolvent now, but higher rates would just put them into insolvency. It would be much worse than what happened in 2008. And rates high enough to stop inflation would cause the U.S. government to have to default on its treasuries. And so these are completely off the table for the Fed. The Fed is not going to put the government and the banks into that position. So the only way it can do that is not to raise interest rates, or not to allow interest rates to go where the market would otherwise send them. And that means that inflation ends up being much worse. And the higher inflation gets, the more incentive people have to get out of bonds and buy gold.